Please welcome Dr. Jim Gaines.
Howdy. Charlie stole my line because, yes, I am now solely responsible for the collapse of the housing market, particularly in central part of Brazos County. As soon as I listed my house, the whole market just disappeared after having set records for the last 2 years of what was going on. This is great. I mean, if you're not aware of it, I think this is our largest attendance at this conference that we've had. One of the first things that struck me this morning, the tables are closer. It used to be I had more distance. You couldn't throw things as well up this way, but they're closer. It maybe you feel a little more closer together with each other, but it's a tremendous benefit to have everybody here. Thank you for coming. We'll see how it goes. I know, and here it is early in the morning, and what do you have to do? The very first thing you have to listen to is an economist. Oh, whoopee. And what I'm here to do, to tell you about economics, it's the science of explaining tomorrow why the predictions that we made yesterday didn't come true today. And so I'm here this morning to explain to you why all those things that I told you at this same time, at this same conference last year, really didn't, some of it happened and some of it didn't. Something happened in November, though, that diverted attention. And it was like a Yogi Berra-ism. When you get to a fork in the road, take it. Yeah, think about that one for a second. I know. Let me tell you where I think we are on the economy and what's going on. And we're at an interesting point in time, literally, sitting here at the end, toward the end of April and the beginning of May, of what's going on. We have been in a period of time for the last several months of extremely rapidly rising optimism, just awaiting reality. And that is what has happened in the last several months in the economy and across the country about everything. And it was really a unique experience because, quite frankly, it was so unexpected. I was talking to a banking executive just a few weeks after the election last November, and they were lamenting the fact that on November 7th, the day before the election, they had hired in and brought in like 4 economists to explain to the senior membership of this big bank what it was going to be like under a Clinton administration. And my only response was, well, you got what you deserved. You didn't ask me. You paid all these high-priced economists to come in, and so it was all worthless, and it all changed overnight. And what happened? It's very interesting what's going on and what has been going on for the last 90 days, 100 days or so. We've seen the rising optimism. Every survey measure of what's going on in the economy. Small businesses, large businesses, consumer confidence, home buying, you name it. Now, there's going to be graphs and charts coming. I'm not going to leave these words up here for all. There's graphs and charts coming. I'm going to show you what I'm talking about, some of these things. But what the reality is now kind of taking some shape is that some of the measures, the actual statistics and the measures of what's going on, like employment, like trade, like other things that we'll look at, they're not living up to some of those expectations. And that is a problem of human nature, that as we have rising optimism and as we take a more positive approach across the board to things, what happens? Expectations just elevate and elevate. Everything is going to be so perfect and so good. And the reality might be, in fact, the reality will always have trouble living up to that level of expectations. All right, let me talk about what I think is going on in the U.S. economy and see where it's going. And I'm sorry, I apologize. I had to use that first line. It just, you can't avoid it. You have to use it. Will he trump the economy? I don't know. The jury is really still out. We've had the Trump bump in the stock market. We've had the Trump bump in interest rates. We've seen it in some of the other categories of things that we look at. But we'll just have to see. It's really a little too soon to measure it and see it. And quite frankly, for those of us who've been kind of trying to look at it, it was going to take a really, really significant set of circumstances and actions to make anything actually literally happen in a short period of time. I mean, the U.S. economy is like, one of those big ships at sea. You don't just turn on a dime. It turns more slowly in any direction. So we have to kind of see what's going. The other thing that's unique, or not particularly unique, but we keep in mind, is that the world has changed in the last 10, 15 years. And what we're seeing is that a new normal has sort of evolved in terms of a rate of growth. Since World War II, the average rate of growth in GDP has been about 3.4% a year, plus or minus. And what we've been averaging the last 6, 7, 8 years is more like about 2.2%. A good, significant change from that. And the factors that are in place to cause growth and to fuel the growth are simply not exerting the kind of pressure to cause that kind of rate of growth. Again, we'll just have to see. I can tell you, on November 9th, every economist in the country changed his projection of the future. Every one of us did it, almost universally. There's always somebody, it's an exception, because you're looking for the press release. But almost everybody raised their expectations 2 or 3 or 4 tenths of a percentage point higher. That was part of that rising expectation, that rising optimism that was going to come in play. Interest rates, I gave you my projection for interest rates last year. I stuck by it. They will change. And lo and behold, they did, and they have. It's been an interesting ride on interest rates. We'll talk a little bit more about that in a minute. Inflation, it's been ironic that one of those levels of optimism in the surveys and among economists has been that we're expecting inflation to actually be higher. It's been running about 1% or a little less on the overall CPI for a number of years, and now we're expecting it to be higher, to approach the 2.5% level, which has been sort of the target, the general notion all along for the Federal Reserve, and that is viewed as optimistic, which is ironic for those of us sitting in the audience who've been following the Fed for the last 40, 50 years. The primary role of the Federal Reserve has been to keep inflation down. We remember the 79-80 period with the high interest rates and high inflation. Ironically, the Fed for the last 6 years, 7 years has actually been trying to create inflation. And they've been real surprised that they couldn't do it. I mean, they pumped about $3 trillion out into the economy and couldn't produce a level of inflation that they thought they could get away with. Anyway, so inflation, more likely to be a little bit higher. Have to see how that goes. Industrial production, manufacturing, we're producing more. We're producing more output in the manufacturing sector than ever before. The reason it's not helping with the growth on the GDP, though, is we're not employing people to do it. Anybody right now who's working in the manufacturing sector earning less than $20 an hour, their job is in danger, in severe danger. And it's not in danger of being shipped overseas or offshored. It's in danger of being replaced by automation and technology. That's been the big hit on the manufacturing employment sector rather than the outsourcing. And the housing. The U.S. housing market, believe it or not, has not actually recovered from the 07-08 recession. Everybody kind of thinks it has, but it hadn't. And when we say housing here in this context, talking about new construction, we're running about 80%. Again, I got charts and graphs. I'll show you the numbers here in a little bit. I know you're all anxious at the bit there. Jobs are expanding, still looking for that driver to go. Here's some of those potential changes, and we could have an all-day discussion about some of these things. You're as aware of them as I am. The one that's on the table right now, it appears, after the health care debate and scenario that we went through about a month or so ago, now is the tax reform. This is going to be important. It's all kinds of tax issues. I think Kathy last night mentioned at the RLI reception the 1031 exchange is on the table. It's in danger. That may affect you in the rural market maybe as much or more than the commercial investment market for improved real estate and investment real estate, because the offset on the investment real estate side is to allow the first year write-off, 100% write-off, and do away with depreciation. That's one of those things that they're talking about doing. I don't really think that's going to happen, but that's a personal opinion, just because. Mainly because I guess I work for two big accounting firms, and they also have big lobbies, and it would put too many tax accountants out of work. Those are the kinds of things that are happening. Infrastructure and defense, yeah. Is there any debate that we need infrastructure and improvement and repair? Spending $1 trillion probably isn't even enough. And where is that money going to come from in the increase in defense? You know, the other side of the coin is if you're going to spend all that money, you got to go get it. Now, scariest thought that I'm going to leave you with today. We now have a real estate developer who is the president. You've all experienced real estate developers at one time or another. Just think about it. What do all real estate developers have in common? They know about other people's money. They know how to use debt, or they use it and they're not afraid of it. And this president in particular has a good track record he has a track record of using debt considerably. And quite frankly, that's probably where it's all going to go. So we'll have to see. Monetary policy, the Fed policies, interest rates. Interest rates probably are going to creep up, but I think the operative word there is creep. I don't think they're going to jump. I think they're going to move much more slowly. And of course, the regulatory. That was one of the things that got the business community real excited, was the concept or the idea or the expectation that somehow the regulatory burden and red tape and so forth was all of a sudden going to magically disappear and go away. And that's not really all that realistic, because all of the bureaucracies that were in place with those rules are still there with the same people. They don't change. So getting rid of that regulatory burden, you could probably do it at the law level, but not at the agency level. Trade, foreign trade, particularly important for Texas. Something we really do need to pay attention to. Texas is the #1 export state in the union. It's a major part of our factor in our state's economy. And of course, who is our major trade partner? Who do we trade the most with? Mexico, to our south. Particularly down, if you're in the communities where the maquiladoras, their products and services going back and forth across the border daily. So it is important to Texas what those agreements look like, what happens, what the arrangements are, and how the trade in international trade is affected. I know that there's this thing called the BAT, the Border Adjustment Tax, that's being thrown out. There was an editorial the other day by Kevin Brady, who was defending it. But we'll have to see whether or not that gets implemented, and then see what that impact is going to be, particularly on those of us here in Texas. Okay, let me get some graphs and charts, get you some data. This one I gave you on purpose, because the blue line on here is the actual month-to-month change in employment at the national level. The red line, if you can see it running through there, is a 6-month moving average. It just sort of averages out and smooths it out. And 2 points. You can see how volatile on a monthly basis change in employment is. But if you look at it a little bit more on that 6-month moving average, it's a lot more stable. Last month came out 98,000 jobs, not quite half of what the normal expectations. We've been averaging since 2010, averaging about 200,000 jobs plus or minus a month. The expectation had been that we'd add between 180 and 200,000. Comes in at 98. That's a whole lot less than expectation. People get nervous. My point is, don't pay attention to 1 month. It's just like in your business, in real estate, in land, and in other forms. 1 month change generally doesn't mean a whole lot. You have to watch and see what it does over time. Now, if we stay at that level, that's a big problem. That's a big problem. If next month it bounces back up and we add 250,000 jobs and it averages out, it's not a big deal. So we just have to wait and see what those things are doing. But the other part of the slide, notice how it's been stable. It has lost some of that big volatility. You can see the big dip. That's the hump over. I've given you that phrase before. The hump over back in the 07, 08 period. When it fell off the chart. Here's inflation. It has been quite low. In fact, it was down to 0 at one time, and you can see how it's moving back up. Again, this is viewed as rising optimism among economists because it indicates a growing activity level. It indicates more things happening, people out buying and selling goods and services and creating price increases. That's actually a good thing as long as it's at moderation and at the right level. So we have to watch that and see what's going on. Another one is consumer confidence. And again, this is survey. The conference board surveys people and asks what's your attitude about current events, future expectations, et cetera. So there's a series about 6 or 7. This is the overall composite index. You can see that the red bar, the red line rather, is Texas. Texans have been and continue to be far more optimistic than the average American. After all, we live in Texas. But you can see how both of those indexes have jumped up in the last 2 or 3 months. They just jumped right up off the scale. Again, that level of expectation, that level of optimism that the economy is doing well, that I'm going to spend money, and as I have preached before, you think this is an economic presentation. This is more of a sermon. The economy and economics is a pure behavioral science. It is not a physical science. It is ironic to me and just completely anathema that to get a degree in economics now, you have to take 4 semesters of calculus. And I'm serious. You can't get a PhD in economics anymore without 3 or 4 semesters of calculus. And there's no psychology. And it doesn't make any sense to me because really what happens is how people think and their attitudes and how they react to changes and so forth. It's a behavioral science, not a physical science. Sorry, I got up on my soapbox there on that one. Small businesses, the National Federation of Independent Businesses, they also survey Main Street businesses and find out what they're thinking about. And you can see how that optimism index just jumped right up off the scale right after the November election. Nothing actually happened other than the election. But the level of optimism, the level of expectations just jumped up off the floor. Now, a little bit of, here's that cautionary word that I've had. Look right out at the tail end of that little blue line and you see it beginning to dip a little bit. Now, some of that is just reality coming into play. Some of it is the normal reaction of the knee-jerk reaction and then come back and really think about it and get realistic. We'll have to see how that plays out. But Main Street, the business sector got very optimistic, and still to this day, actually still stays that way. They're again expecting the tax reform and the regulatory reform issues particularly to help their businesses and see where they're going. Interest rates. Said I'd talk a little bit more about interest rates. The red line across the bottom there is the federal funds rate. That's the rate that every 6 weeks you read about in the newspaper when the Fed has its open market committee meetings and they make the announcement of what their target is going to be for the overnight bank lending rate. That's what that one is. And they don't actually set the rate, but they set a target, but then they act and they buy and sell securities and do other things that more or less influence what that rate really winds up being. They raised the rate in December of 2015. They raised the rate again in December 2016. They did it in December hoping nobody noticed during the holiday period. And it worked because when they did it the first time in 2015 and they thought interest rates generally would go up, it didn't happen. They actually fell. The short-term rates, the longer-term rates actually fell. They raised it again in December 2016, and most people ascribe the increase that we've had in interest rates since then to the Fed doing that. Not true. The Fed followed. Interest rates started jumping on November 9th, literally on November 9th. If you went back and tracked on a daily basis, and incidentally, the next chart's going to show you. If you go back, you'll find that the interest rate started jumping on November 9th, and by December 20th, when the Fed got around to doing their 25 basis point increase, it was a so what. It didn't mean much. It didn't do much. They've done it again since then, and we'll have to see. Now, you can see, though, that the 10-year Treasury, that's the blue line, and the 30-year mortgage rate, fixed mortgage rate, went up. And here's what the mortgage rate looked like, for example. From November 3rd to the end of the year to December 29th, it jumped about 66, 67 basis points. Bingo, just overnight. Was there a real reason for that to happen? Was there a financial reason? Did something happen miraculously in the market? Was there a fall off in the supply of loanable funds or an increase in the demand for borrowed funds that would cause an interest rate to move? No. It was purely an emotional, psychological reaction in the marketplace that the expectations were, and of course interest rates in a sense reflect future expectations of where the economy and where investments and where prices are going in the future. That's a current rate. Interest rates are set by the market, not by the Fed, not by the government. So understand that the supply and demand for money, just like the supply and demand for cotton, corn, wheat, oil, anything else, is a market function based on supply and demand, and money is the same way. So the interest rate cost is going. What's happened since then, after the initial knee-jerk reaction of the increase, is it's kind of just leveled out. It's wobbled, that's my word for it. It's wobbled at around 4 1/8 for 30-year fixed rate mortgage financing, but I'm using that as my long-term rate measure. So you see how that's going. So what we see then at the national level gets translated down to Texas. And of course, Texas has been a little different. We had a boom. Texas had a boom in it. Sounds like a song, doesn't it? Anyway, 2010 to 2015, big boom time. 2016 became transition. We thought, or I thought, the transition was actually going to be in 2015, got postponed a year. 15 turned out to be a very good year. 16 actually turned out to be a remarkably good year, considering what was going on. That starting in the summer of 2014, price of oil started declining. On Thanksgiving Day of 14, price of oil, OPEC and Saudi Arabia, I think Detlef is going to talk more about this, continued to go down, went through 2015. The hedging and the futures market spread out the impact immediately so that the producers weren't hit as overnight as hard as we were back in the 80s. Some of you remember the 80s. It was in all the papers. And the percentage decline, you know, in the oil prices this time around and in the rig count here in Texas was a greater percentage decline than what we went through in the 80s. Okay? So a lot of expectations, back to the expectations thing, the expectations was we would have a similar or something like that economic collapse that we suffered in the second half of the 80s was a possibility, and people were concerned about it. Didn't happen. We're a stronger economy, far more diversified. We also didn't have 700 S&Ls to go broke. We also didn't have all of the major banks to go broke. I mean, there was a number of factors of why this time around was indeed different on it. But 2016 became our transition year. The economy, and incidentally, the national economy didn't do all that well in 2016. It didn't make 2% on GDP growth. It was 1.6. I mean, that wasn't particularly a good year. Texas, somewhere, the estimate is it's somewhere around a half a point, 0.5% for GDP growth. So we did fall off significantly. 2017-18, I love it. Not a one-handed economist up here this morning. Definitely a two-handed economist, unlike what Harry Truman wanted. On the one hand, 2017 and 18 could be really great years. On the other hand, 27-18 could be really difficult years. You take it. We are now even less able to predict the future than the weathermen. I mean, we got algorithms and so on, but we can't watch we can watch cloud formations, but they're all over Washington. And And the problem is that trying to predict what the economy is going to do this year and on into 2018, we are reduced to having to make political forecasts and political expectations. What are the politicians going to do? And of course, as most of us are observing now, the politics of our country has gone more into we versus them, or them versus us, the Republicans versus the Democrats, and instead of cooperative. I mean, it's always, all of the votes are coming up, you know, we've got to win and you got to lose kind of thing. And it's creating a very difficult situation for us to try to anticipate then what the economy. So if we could ignore the politics and the politicians, which would be utopia, we would have a much clearer picture, because business people don't get into, generally, the we versus them. It's more of how do we get to where we're trying to go. So that's the reason I'm here to tell you today, and that way I can tell you when I'm here next year, assuming I make it to next year, that I was right. It was a really good or great or bad or something year. Hey, I was right. Well, either way I go, it's gonna be right. We'll have to see. Let's look about Texas then. We did definitely slow down in 2016. Some of that slowdown, though, we think is probably biased. The immediate and strong impacts on the energy sector, the oil price declines, on mining and manufacturing employment and so forth, most of that impact has been felt. In fact, for the last 2 or 3 or 4 or 5 months now, mining and logging, which is the category in the Texas Workforce Commission Bureau of Labor Statistics data for energy, has actually been up for the last several months. And more people employed than less, but much fewer than a year earlier. That's the reason it still comes out as a negative number, because it's a year-over-year kind of number. Construction is slowing down a lot of the downstream energy construction, a lot of it along the coast in Houston, down to Corpus, even over into Beaumont. Some of that is now kind of coming to conclusion, and there's the concern there is there's not a whole lot of big projects in the pipeline coming along to replace them. We'll have to see. Residential construction, commercial construction, and the real estate industry still going strong. I counted in College Station the other day 8 of the big cranes. That's the state bird is very fluent and there in the state. Go to Dallas, you still see a lot going on. Dallas has not slowed down at all. Dallas-Fort Worth area, that whole area of North Texas has really, it's a little bit slower statistically, but in essence, it hasn't slowed down much at all. The central part of the state around Austin has slowed down a little bit, but Austin was just going so hot and heavy, and that whole central Texas area was going so hot and heavy that it was inevitable. It had to slow down a little bit. Houston obviously got hit the hardest of the major metropolitan areas around the state, and it's been very mixed around the rest of the state for our mid-market or our smaller MSAs and the rural markets around the state. Very mixed, some up, some down, depending on some of the other impacts. And energy may or may not play that much of a role in a given area, in a given county around the state. I know Charlie's going to talk more about that when he gives you the update on the land markets. We should be better. Healthcare, business professional services, other parts of the economy in Texas are still stepping up. And again, we're kind of dependent on what happens at that national level I was talking about. If it does improve, if it continues to grow, it's going to help us. We're going to go as well. If there's a national recession, a global recession that maybe leads to a national recession, which actually the odds for that are going down a little bit right now compared to what they were about a year ago. But if that happens, then we would feel that impact. That's the reason Dallas-Fort Worth is still doing well, the reason Austin is still doing well. They were not tied to the energy sector all that much. J.R. Ewing notwithstanding, Dallas is not the oil city that Houston is. I mean, they set that in Dallas and call it Dallas. I don't, but the business is all in Houston to the extent. Houston, I mean, Dallas has some, but nothing like that extent. So it's interesting to see it. We'll have to see how that goes. Texas job growth is picking up. We did better last year than we thought. That was the reason last year At this time, when we were together, we were a little hesitant about job growth in the state. We thought it would probably come in less than 1%. We thought it'd be something like about 0.5 to 0.75%. Turned out to be 1.5, double what we thought. Shows you what we know. But and we're looking at about 2% this year, which would be really good job growth in our state for this year. So we'll have to see. Population continues to expand. I'm going to talk a little bit more about that. Local growth issues. Y'all hitting local areas, cities, counties, getting more involved with how land is used, how the growth goes, permitting and platting for any kind of expansion. Land control, water control, of course, for many of you becomes a big issue in your local communities. And it's more and more and more getting involved at the local level with growth and growth controls and growth management and land use management controls that are affecting, and they're coming from all directions, every which way. EPA, water, it doesn't matter. It's coming from all kinds of directions. All right, some raw numbers. We grew about 1.3% in job growth last year. You can see we continue to just continue to stack on new jobs. The Dallas Fed releases every month a job forecast report that they do. They do a great job with it. They're looking at about a 2.3% job growth rate for 2017 for Texas. That varies. It changes every month. But that's what their current outlook looks like. Of course, there are a number of variables that play into that, but one of the important variables, and Delip, I don't mean to step on your toes here on your presentation, but just as a quick overview, you can see the dark line here in this slide is the rig count and how it has changed, how it fell off of the cliff starting back in 2014, 2015, but lately, in the last year or so, has been dramatically increasing. It's back up nearly to 240, it's up 240 rigs, up near 400 active rigs, or rigs, since May of 2016. You can see the other line there. It's currently an orange line. It used to be maroon, but when it started declining, I changed it to orange. No, I didn't really do that, but it makes a good story. But you can see how the price of oil, the West Texas Intermediate, it looks like, and the preliminary analysis is maybe these have troughed. Maybe they've hit bottom, both the price and the rig count, and now coming back up. We know that the technology in the fracking industry is such that maybe we'll never get back up to 900 rigs simply because we can produce so much more with the rigs that are being, and the wells that are being drilled today. We simply don't need numerically the number of rigs that historically ran, which is going to have an impact on the oil field services and on the employment levels and so forth, granted. But then, and also the price. Incidentally, that's one of the reasons that inflation number is coming back up, because the price of gasoline at the pump isn't going to keep going down. As this price of oil per barrel keeps creeping up a little bit, the price per gallon on the gasoline at the pump doesn't come down. And that is part of the CPI, the overall CPI. So we'll have to see. This is important news. Really, that price is probably going to flatten out. We think that it'll probably be somewhere, for what it's worth, between $45 and $55 a barrel, hovering, wobbling, if you will, around the $50 level per barrel. That's what our economic projections that we're doing at the center are based on looking at. Retail sales, this is another one that's kind of tricky. If you're following at the national level, the last several months, retail sales have not been keeping pace with expectations. And that's a major issue at the national level. And again, one of those data points that I'm talking about, that when we look at specific stats, are not supported by or are not supporting some of the expectations that things are getting better. And that'll eventually show up in that independent business survey. In Texas, it's interesting because, of course, the comptroller had to estimate taxes for the legislature, which is now in session, having to issue a budget based on tax revenues to the state. State's primary source, or one of their primary sources of revenue, sales tax. as we know. So here's what it looks like in terms of the pattern. It's actually more or less on trend, on long-term trend. We haven't seen that much of a fall off. So the state of Texas is doing pretty well economically. We've managed to survive, not only survive, but actually almost prosper in a relative sense, despite the economic downturn or the energy downturn, and be able to keep going without a major depression, without a major recession, which was a bit of a surprise, a little bit of a surprise, a pleasant surprise for people who monitor it. Let me talk about people. I keep emphasizing how economics and business activity is really psychology, which means it's a people issue. So let's see how people are doing. 2015 population, that's the last year we have these really good numbers for you. Population of Texas was right at 27.5 million people. You can see how we have a lot of people between 0 and 15, despite the fact that parents want to really kill their kids when they hit about 15. If you're a parent, you know what I mean. But I know everybody's sitting there nodding their heads. You won't acknowledge it, but you know it's coming. But you can see how it's coming. The millennial group, the 23 to 34s there, very large. About a little less than 12% of the good guys out there on the far right. Here's a major thing about the Texas demographics. We're growing very fast. I'll show you here in just a second. But we are the third youngest state demographically in the country. The median age in Texas is 34.2 years. That means the millennials, half the population's less than 34 years old in Texas. The millennials are there, but 34.2 years. There are only 2 states in the union to have a lower median age. We have little less than 12% right now that are 65 or over. There's only 2 states in the union that have a lower percentage of elderly, listen to me, that have a lower percentage of the good guys as their population base. Incidentally, for your trivia for the morning, it's the same 2 states. Any guesses? Nope. Nope. Washington? Nope. California? Nope. Florida? Nope. You're not going to get it. Alaska and Utah. Think about it. Utah got a lot of kids. And all 8 people in Alaska are younger than anybody in Texas. So yeah, we don't measure up to Utah and Alaska, but that's a significant kind of thing. A young state means labor force, it means housing, it means social, political ideas, because young people tend to be far more liberal than older people. They're much more tech savvy. They're all on their computers. They go out, teenagers today go out on a date and they go have dinner and they're texting across the table to each other. They don't talk. Eventually, the art of speech is going to be lost completely. It's all going to be thumbs. If you don't know how to use your thumb, you're going to be incommunicado. It's going to be nuts. But it's also got implications in the real estate market. Our housing, our households don't own as many houses. Our homeownership rate in Texas is nearly 5 percentage points less than the national average. It's particularly lower in the Dallas-Fort Worth area, the Houston area, and the Austin area, as you might suspect, because one of the things that's been stimulating the growth, of course, in Texas is job creation. It's been attracting people from all over the country, from all over the world, to come and find jobs. Those are typically younger people. They are far more mobile. Between 2015 and 2016, just the year, the 2016 numbers just came out here about a week or 2 ago. Houston and Dallas, the metropolitan areas, were the only 2 metropolitan areas in the country that gained more than 100,000 people in 1 year. 1 year. The Dallas-Plano-Irving municipal division, which is the subdivision, they separate Dallas and Fort Worth. Just the Dallas portion gained more than any other MSA in the country except Houston. Almost 100,000, right at 98,000 people, just in the Dallas, Plano, Irving area. So our population growth is tremendous. Incidentally, Austin is now over 2 million, metropolitan area, the 5-6 county area, over 2 million people. It just surpassed both Columbus, Ohio and Cleveland, Ohio, and is now 31st rank MSA in the country. This is how fast Texas is growing. We are, of course, the fastest growing state. It's been remarkable. Texas added about 433,000 people, almost 1,200 people a day in population. Now, let me tell you, that's total population. Of that 433,000, in round numbers, it's not exact, but in round numbers, about half of that was births over deaths. That's the natural increase. Having young people, we're fertile, we got more, and the good guys are living longer. So the birth over death, the natural rate of increase. But the other half was immigration, both domestic and foreign. And that breaks out about 55, 45, 60, 40, something like that, domestic over foreign. Last year, in years past, it's been more foreign. So we are growing with a lot of people moving into the area. Since 2010, for example, the Dallas-Fort Worth area has averaged adding about 130,000 people. Houston has averaged adding almost 138,000 people. I mean, these areas are growing. And now Austin, the central Texas area, growing. That's important for the rural land market because it is also people create the demand for land to go out, for second homes, for recreational land, for the gentleman farm, and then, of course, for the farming, for the agricultural uses and so forth. So we're seeing those kinds of things happen. We're going to see it continue. I've given you this slide before, but I'm sure since you didn't commit it to memory before, I'll have to give it to you again. In the 40-year period from 1970 to 2010, Texas grew by about 14 million people. From 2010 to 2050, we're projected to grow for about 30 million people. That's a lot of folk. And incidentally, it's 27 million more cars and trucks. If you haven't figured it out yet, we're beginning to choke ourselves. We've got some real significant infrastructure issues and basic resource issues. Basic resource, water is a major issue in the state, of course. Well, actually, it's a major issue anywhere west of I-45. If you're east of I-45, you just look at a map of Texas. East of I-45 is really not much of a problem with water. I mean, there's cost and delivery and stuff, but it's there. It's plentiful. And between 45 and 30, isn't it interesting we can divide between interstates? Between 45 and 35, it's not too bad. There's some issues, but anywhere along 35 and then west of 35, water becomes a much more. But other infrastructure issues, transportation particularly. I'm sure most of you drove into San Antonio. Wasn't that a lot of fun? And San Antonio is considered, not particularly that bad. Okay, if you live here, it's horrible because if you've lived here for a number of years, it's nothing like it was. I started first coming to San Antonio on a regular basis in the mid-'80s, and man, you could come all over town. You'd go anywhere. 1604, there wasn't anything up there. It was a 2-lane road, right? So it was easy. But everywhere is getting wet. Austin is choking itself. Dallas and Houston both choking themselves, and that's the reason why it's going further out. And of course, as it goes out into the suburbs, into the exurbs, and then into the rural areas, it's affecting land uses, land prices, and the demand for land as it goes out. And the only way to get there is to go further out. And that's always been the Texas paradigm. Just go another mile down the road and find another 100 acres and go do it down the road. And we're seeing that paradigm actually come into play. I don't mind giving you a 2050 projection here of being over almost 55 million people because, hell, 2050, I'm not going to be here to defend it. But I need to tell you, that projection is from the state demographer's office. They do update that projection. You can go out to their website, pull the number down just as well as I can. The change You can see again the rate of change over the next 40 years. We're going to double roughly our labor force, the 18 to 64s. The good guys are going to grow the fastest. That's the bar to the far right. The overall increase is more than double, bigger than any other state. The percentage over 65, for those of you who like to see these things. And then there's all kinds of ramifications within and on the demographics and the changes that are coming about. Education is going to be tested. Our legislature still can't figure out how to fund the schools. Property taxes are not going to go away. I can just tell you that right now. It's not going to happen. And how it's all going to work out, you know, there's no magic cure for that. There's no magic pill that all of a sudden is going to come out and solve all these financial problems. Let's talk about the housing. Charlie said that I'm the housing guy, so you get to hear about housing. The big issues on housing in Texas are going to be demographics, what I was just talking about, and how the demographics affect the demand, rent versus buy. How many of you have noticed that apartments keep sprouting up like mushrooms everywhere, right? That's because that median age of 34, half under 34. Think about when you were in your 20s and 30s. What did you do? Did you rent or buy? You probably rented, if you're like most, okay? And the lifestyle and the life choices of the millennials, the 18 to 36, they're getting married later, having fewer children, having children later in life, so they're not as anxious to get into the home ownership market. That's the reason for all these apartments. And the demographics of the in-migration support it. But the size, the location, building houses now with 2 master suites instead of 1, because we're going to have multi-generational housing for people living with the parents and the grandparents. I mean, I told my son, who just did a house down in Houston, that I want my room to look like this, and I want a bathroom, because I'm moving in next month, and he doesn't know it yet. But my wife and I are going to come down there and you know, when we can't do it. Affordability is becoming a major issue, not only in buying a home, the price of housing, but the rents. We just have a new apartment project in College Station, College Station. Get this one. And I got a flyer for it. It's going to open up, I think, this month. Starting rent for the apartments, $1,800 a month, ranging up to $2,400 a month. So if you got a kid at A&M, get ready. Keep them cards and checks coming. I mean, the rents are getting, go to Dallas, go to Houston, go to Austin, but it's going down to the smaller communities. Go down to Corpus. Go over to El Paso. Go to Lubbock and look what rents are doing for apartments and so forth, and you'll see the similar kind of pattern of the costs going up. Land costs are right now the #1 cause of new home prices increasing at the rate that they're going up. It's not only the cost of the land, it's the cost of developing the land, but it is also the regulatory cost, the cost of dealing with the regulatory burdens, the platting, the permitting, the environmental impacts, the zoning, and so forth, that's causing land prices and the percentage of land as a cost of the total cost to keep going up, driving the cost of new homes higher and higher. Development, all of the developers are looking for ways to do it bigger, faster, cheaper, quicker. Generally, it's higher density. More people now with that growth in population, and particularly the millennials, again, they're aggregate and conglomerative animals. They want to live together, they want to live close together, and they want to be near all the amenities. They want to be near the bars particularly. They want to be near all of the sports venues and jobs and so forth. So there's more pressure to live in a more concentrated area. Anytime you have that kind of demand concentrating into a small area, what happens to construction? It goes up. Prime example, 2 prime examples, New York City and San Francisco, okay? I don't have the slide, ran out of time. Got a billboard from San Francisco, new development, downtown San Francisco, from the low 1 millions. Real slide. real billboard. Okay, and it's going that way. Regulatory costs and development, we could go off forever on that, but that again is that optimism that somehow that regulation and that regulatory environment is going to ease off and so forth. We'll believe it when we see it, just to be a little bit of a pessimist. 2016, though, was a record year in Texas for residential market. We did best year ever. Sales were up 5%. Prices up nearly 8% just across the board. Different markets, same way. 14 of the 25 MSAs across the state set records in 2016. The ones that didn't, the 11 that didn't, most of them were energy-related markets, Midland, Odessa, Corpus, Houston. Some of the others that were more affected by the energy sector didn't quite make it. We led the nation in residential permitting. We're building more houses in Texas than anywhere else in the country. As a matter of fact, there were more homes, new single-family homes permitted in the Dallas-Fort Worth area and in the Houston marketplace, in both of them, than 5 other states. All the other states but 5. And they were both right just at their sort of their average level. It tells you how the housing market across the country has not improved as much, but how fast or how active the Texas market, and it still isn't enough. Literally speaking, that population number count that I was just giving you is going up faster than the housing. It's just supply and demand. Right now, my calculation is, and this is almost a back of the envelope type of thing, but by my calculation, the state of Texas is somewhere between 130 to 150,000 housing units short of what we really should have if we were to have maintained the balance of supply and demand that we'd had in the prior 20 years. That was one reason Texas has always enjoyed the luxury of having lower priced housing than all of the other most populous states and high growth states. One of our major competitive advantages, low cost in state. What's low cost? Housing was much less cost than anywhere else in the country. You couldn't go to a major metropolitan area anywhere else in the country and buy a home, a new home, for under $200,000. You could when you were in Texas until just a few years ago. Now you can't. The under 200, in fact, in Dallas and Houston now, under 250 for a new single-family detached home is, unless you're going to be way out about 30, 35, 40 miles from downtown, you're not going to find it. Land costs have driven home costs up. So we're seeing those kinds of things happen. Year to date, in fact, I need to update my slide. We're now up about 4% on sales. Just got the March data. And we're up about 9% in median home price. It continues. It continues on into this year, and I don't see a let-up. 17 will probably be another record year. Unfortunately, our residential construction is kind of leveling off a little bit. The single-family home market is only up a handful of percentage points, 2 to 5%, and the multifamily fell off actually last year. The financial markets quit financing some of those apartments that were growing up out of the ground. So we'll have to see how that's going to go. Everybody is doing so. We have developed at the center what we call a residential construction leading index. It's very much like the overall economic leading index that the Dallas Fed does. We look at a number of variables to try to give us an idea of which way the residential construction market is going. And I will report to you, it's now the highest it's been in the last year. It's moving upward. It had been wobbling because of the price of oil for the last year or so. It is now trekking upward. And so we are expecting some improvement here in our residential. I've got a lot of detailed statistics that I put together on the housing market. I'm not going to go over all these. I just gave you the high-end summary of it. Months inventory there at the bottom of that first page. We are still running about 3.5 months inventory around the state. 6 to 6.5 is normal or balanced market. It's not there, we're not there, and we're probably not going to get there. We just can't do it fast enough unless there's a big fall off in demand. Now, in College Station, it's now going to go to about 12 since my house is for sale. But around the rest of the state, you're in good shape. I don't have a house anywhere else in the state, so you're okay. You'll have to see. The other is the distribution of sales. In 2011, not that many years ago, more than half of the sales, home sales in Texas, were under $150,000. Last year, only 26%, about half, were under $150,000, and that's a declining factor, very rapidly declining situation. We've been running analysis. It'll be an article, not the next issue of Tierra Grande, but the one after that probably. We've been rerunning numbers looking at the income distribution of households in the state of Texas. Right now, it looks like that about 42% of the Texas households in Texas, by the reported income that they make, cannot afford a house priced higher than $150,000. And incidentally, it was interesting because we noted that a lot of the government policies has been to try to increase home ownership and home affordability, have reduced the down payment. That was with a 20% down payment, incidentally. Base case 20% down payment. The old standard qualified conforming loan with Freddie Mac, Fannie Mae. If you lower that down payment to 5%, it's 45% of the households can't afford more than $150,000. Why? Duh. You lowered the down payment, you got to borrow more money, your monthly payments are higher, and they can't make the monthly payments out of the level of income they got. So what happens is it forces people to buy a less expensive home or figure out how to come up with a higher down payment. Okay, so it's one of those counterintuitive things about housing and housing affordability and increasing home ownership, that somehow by reducing the down payment requirement, you increase the home ownership and the affordability. It just doesn't always work that way. The rental market is continuing strong, mainly because of our demographics. It's going that way, and we'll have to just see how it's going. I think that's going to balance out. The home permitting is still strong. We'll have to see how that's going to work out over time. The residential permitting has been limited because of two factors. Lot development, there just simply hadn't been enough lots. The land development process and the ADC financing from the banks has dropped off. And labor. Labor is becoming a real critical problem in the construction and in the trades. Finding a good plumber, electrician, mason, roofer, carpenter, becoming more and more problematic. We'll have to see how all that goes. Annual Texas home sales, I told you, record year in 2016. You can see it on a regular basis. Future sales are going to be based on job and income growth, mortgage rates, affordability, demographics, confidence. I'm telling you that. I told you about the home ownership rate. This is what it looks like when you compare the national rate, that blue line across the top, with Texas and then our three principal metropolitan areas, and how much lower our home ownership is. The residential construction leading index, we put this out every month online. Go on our recenter.tamu.edu and look at it every month when we do our monthly housing report. You will see that residential construction index. You can see it with home permits. It's beginning to pick back up. Sales doing the same thing. I jumped ahead on you with some of the verbiage. Here's the chart on the 42% of the households. This is by income and what they can afford. You've got copies of this, and obviously you can look at these as you need to. And then with the 5% down payment, here's the distribution of sales that I also covered with you. I'm telling you now, I'm telling you again what I said, and now you can look at it again, kind of the professor's way of doing these things. Notice the big jump in the 200 to 500,000. It went from 27% market share to about almost half. Home sales per 1,000 households. We try to get it down to a common denominator and look at the growth. This is the one that I'm beginning to get a little concerned with. I'm not sure we can keep up this pace of 33 sales per 1,000 households. That becomes a problematic kind of issue. I don't think we're in a bubble. I don't think it's that much of a problem. It's mainly a function of the growth and the population growth and the market setting new standards of what it's going to be. Months inventory down low. I know I'm out of time. Building permits. We're basically, even though we're leading the country and leading the world in new homes, We're just right at our long-term average on single-family home construction. Just basically right at average. That's what that red line through there, that horizontal red line, is the long-term average between 1995 and 2015. And again, permits per 1,000 new households, as we're adding this population and creating new households, as the millennials who moved back in with mom and dad during the recession are now coming out and looking for their own housing, as people are decoupling. That's the new buzzword in demographics. I don't intend to interpret that for you, but we're not building enough units per 1,000 new. Multifamily permits fell off again, and home prices, though, continue to go through, and that's going to continue. Median home price, median land price for developable land for residential development going to go up. You can see the rate of change. Here's the big issue. Home prices are going up much, much faster, that's the red line, than household income. That's the blue line. And that creates, it's real simple. I know I'm going fast, I'm out of time. And that's going to continue going through. Here's what home sales around the state look like. You can see the green areas are up. It's kind of mixed. The major areas are generally up. The mid-markets are a little mixed. Home prices across the board have been up over the March to March, so we're seeing, again, the continuation. I appreciate your attention. I hope I've given you some perspective on the market, the economy. I've tried to cover the waterfront and leading into everybody else. It's perspective. It's like looking at Mount Rushmore, okay? Have you ever considered what Mount Rushmore looks like from the other side? Thank you very much, and everybody have a great time this week.